Welcome all to Acing IB Technicals. So this is going to be an incredible experience where we're going to talk through everything you need to know about how to succeed in technical interviews for investment banking and private equity recruiting. So I'm going to show you two numbers. The first one here is 0.6%. What is this number? In fact, 0.6% is the acceptance rate for JP Morgan's summer analyst program this upcoming year. They had about 630,000 applicants for 4,100 positions. And that number of positions has stayed relatively flat while the number of applicants has absolutely skyrocketed. And so what we see is acceptance rates that are just declining dramatically. Now, the second number, some of you may also recognize, 90%. That's the success rate for graduates of Wall Street Mastermind getting into investment banking. And the story behind that comes because we help you master three things. The first is networking, which is going to land you the interview in the first place. But then once you get the interview, you have to get your behaviorals right to actually get towards the super day. But one of the critical defining features of all successful candidates is that they have incredible technicals. And so tonight, our goal is to help you understand how to think through technicals in a way that will differentiate you and help you pass that 0.6% threshold and get a little closer to the 90% outcomes that we achieve for Wall Street Mastermind candidates. So on the agenda tonight is we've got a dozen real challenging technical questions. Some of these came from prestigious PE firms. Some of them came from prestigious investment banks. And a lot of them came from technicals that perhaps I've written myself as an interviewer at Lazard and Catalyst. And so these are real questions. They're not the sort of questions that you're just going to find in the 400 question guide. And throughout, I'm going to try to intersperse frameworks to make sure that you're not just able to understand what the answer is, but you're able to understand how to think about answering these sort of questions. And so some of these will be quantitative, some of them will be qualitative, and there'll be engagement throughout. Let's check it out. My name is Max Adams. Just want to briefly introduce myself so you can be comfortable with the fact that I know what I'm talking about here. And so my background is in investment banking and private equity. I spent time at Lazard and Catalyst in their technology groups before making my way to Vector Capital as a private equity associate and later senior associate. And most recently, I've completed a dual degree at Stanford in the MBA program and Harvard in their MPA program. And throughout this entire time, more relevant to you, I've coached hundreds and hundreds and hundreds of students on getting these technicals and behaviorals right. And I've also been an interviewer for each of these institutions, writing the technical questions that made them good to go. So with that, get your pen and paper ready. And I want you to track your understanding throughout the rest of the night here. We're about to jump into the questions. We're about to make this super interactive, super fun, super interesting. And I don't want you to just track the stuff that you're getting right. I particularly want you to write down anything that you get wrong, because that's the stuff that you need to go back and study. And we'll talk about how to study it after, but let's get through a dozen real challenging questions. Grab your pen, grab your paper, grab your notes app, throw away your calculator. You're not allowed to use it tonight. So with that, let's start with our first question. So question number one, let's say that you've got two companies that are in the same industry. They have the same risk, the same EBITDA margin, same growth rate. Why might they have different multiples? So take a second, think about that. Okay, let's take a look at this together. So many people, when they look at a question like this, they say, oh, it's going to be like to the management team or the geography. And that's totally fine. It's an intuitive response. However, we also highlighted in this question that the risk is the exact same. And so that leads you to believe that, in fact, this is more about financial question than it is about like a qualitative risk assessment question. And so some of the answers that might succeed in an interview here are taxes, capital expenditures, net working capital, leases, basically anything that happens between EBITDA and cash flow. Because ultimately what we care about as investors is not the actual EBITDA of the business. We don't care about what EBITDA is. We care what cash flow is. And so if you're going to have things in between EBITDA and cash flow, they adjust it, like capital expenditures, net working capital requirements, capital leases versus operating leases, some of these things that are going to actually impact your cash flow. That's the stuff that we care about as investors. And that's sort of the thing that we're looking for in a question like that. So hope that was a good warm up. Let's take a look at another question that's relatively similar. So another question here. Let's say that you have same company and they trade at the same EBITDA multiples, but they trade at different PE multiples. Take a second and think about why a company might trade at a different PE multiple than it would EBITDA multiple. Let's talk about this. Realistically, anything that happens between EBITDA and earnings could feasibly be an answer here. Because fundamentally, if we're saying that the numerator of the equation is the same in both companies, and the denominator is different between the EBITDA and the earnings, then essentially this is going to be something that goes between EBITDA and earnings. And the biggest single thing that happens there is leverage. And so many students get this correct. Many people recognize that debt is the key factor there. A slightly more nuanced answer might involve something like a difference in tax rates or a difference in sort of non-GAAP, sort of below the line expenses that are going to impact something between EBITDA and net income. And so beyond that, you can get creative. What exactly goes in that bucket, but anything in there is going to be incomplete unless you also mention leverage. Hopefully that was a good warm-up. Let's hit question number 3 here. So this one is a similar concept. Again, we're playing around with multiples. We're playing around with similarities and differences between EBITDA and revenue multiples here. And so let's say that we have 2 companies that have the same revenue, same EBITDA, and they're projected to have the same revenue and EBITDA growth. So it's not about their growth prospects over the next year. And the growth is going to be positive, just to be clear. So company A, they have $100 million of accounts receivable and $500 million of accounts payable. Now, company B has the exact opposite. They've got $500 million of accounts receivable and $100 million of accounts payable. There's no other working capital. Which one is going to generate more free cash flow this year? For these companies that have the exact same metrics flipped in reverse at the end of year 1, what's going to happen at the end of year 2? And so while people are thinking through this, I also just want to talk about some of the concepts at play here. This is talking about net working capital. This is a question about how much money it takes to grow the business. And so your net working capital most commonly is your accounts receivable, your inventory, your payables, maybe deferred revenue if your software business is sometimes considered part of working capital. And ultimately, that is something that helps you understand what the cash dynamics are in the business. And so the cash dynamics in the business are extremely important because as the company grows, is it going to take more cash or is it going to give you cash as it grows? And so these are fundamentally very important things to understand as an investor or as an investment banker analyzing the prospects of a business. So I'll give you a hint on this one, which is that most of the time people get this wrong because a lot of people, they're going to say company A, but in reality, it depends. And so as you think through this, you probably assume that the net working capital accounts are going to move with revenue. And so you've got the accounts receivable and the accounts payable both going up. Technically, you could account for accounts payable with COGS projections, but realistically, that's also tied to revenue. And so as both go up, the key insight is that the business that generates more cash in any given period is probably going to generate more cash in the future. And so looking at a company like this, where if we have one business that has a huge amounts of accounts payable and very little accounts receivable, that means that they're collecting on the revenue that they generate really quickly, and they've got very lenient terms with their suppliers. And so the accounts payable is quite large. And that means that going forward, probably going to be a similar situation. Hopefully that makes sense. Let's take a look at another question here. So what are some methods that business managers can use to manipulate earnings by changing accounting policies? Take a second and think about this. And the reason that this question is so important is because as a financier who's on the other side of the table from these management teams, a lot of times you've got to kind of spot where they are in terms of what they're doing with the financials, because EBITDA is not EBITDA and revenue is not revenue. It's like it really depends on the actual granular policies that these firms and these management teams use to define what their earnings are. And so you have to be very savvy. It's almost like a game of detective or a game of like a legal battle where you're going through and you're thinking, you're putting yourself in their shoes and you're saying, I wonder how they could manipulate earnings if I were in their shoes, while still staying within the legal bounds of what's allowed from finance rules and like what GAAP will allow and what the SEC will allow. And there's a surprising amount of bandwidth here. And hopefully you've got a couple ideas. So let's take a look at what some of the most common things are that management teams use to manipulate earnings. The first is revenue recognition. This is a very common one that's extraordinarily easy for students to overlook because you don't think about it. You just say, isn't revenue revenue? But in reality, with businesses that have multi-year contracts and complex obligations fulfilled to do this, it can either be accelerated or decelerated depending on the way that you think about it from a methodological perspective. And that means that you can shift revenue forward or backwards in the business depending on how you want to do it. The second thing is expense recognition. And so a lot of people can think about, hey, do we want to accelerate or defer the recognition of these expenses? Like when do we want the timing to be? And you can shift things on or after the year so that you can kind of artificially inflate or deflate earnings. And so, for example, let's say that you're running a business and you need to buy 1,000 new laptops for your employees. If you buy those on January 1st versus December 31st, you're going to have different earnings pictures, even if realistically the fundamental quality of the business doesn't change between those two dates. Beyond that, capitalization of expenses is a very big one. Do you capitalize something? Do you lease it? Where does that go? And then depreciation and amortization, probably the most famous one and the one that students call out the most is that there's different depreciation policies. And so depending on where you are in your depreciation policy, you can either juice up or juice down some of the numbers you have. And then lastly, the inventory policy is something that a lot of people also call out. You can switch between LIFO and FIFO accounting. And depending on whether you're in an inflationary or deflationary environment, that can actually also have a meaningful impact on your earnings. So let's keep marching forward here. Question number 5. What are the 3 major drivers of returns in LBO? Now, if you're unfamiliar with a leveraged buyout analysis, basically this is a concept where you go as usually a financial sponsor like a private equity firm, and you go buy a company. And you go buy the company not just with equity that you're taking out of your own wallet, you're going to a bank and getting leverage on top of it. And so you've got the bank's money and your own money, a little bit of your own money, and you're going out and purchasing a company and then using the company's cash flows to pay down the debt. So that's the concept of a leveraged buyout. And so now the next question is like, what's actually going to drive the returns there? Is it going to be the quality of the asset that you're buying? Is it going to be something about the loan that you get from the bank? Is it going to be something related to the growth rates of the industry or the company that you're looking at? If I had to pin it down to 3 main drivers based off of the many LBOs I've built and the deals that I've worked on in my career, I would say, first off, EBITDA growth, second off, multiple expansion or contraction, and third, how much cash you generate. So the first piece that I'm saying about EBITDA growth is realistically, I don't care quite as much as if your revenue grows as if your EBITDA grows. And perhaps even you could just say free cash flow growth here, because what you're looking for is ultimately like either the business is growing like this and profitability is staying flat, and so EBITDA grows, or the business is growing like this and profitability is going up, and so the cash flow is going up. And so I don't really care which of those things it is, largely speaking, it's just did the cash increase? The second piece, though, is the multiple expansion and contraction. And this one is kind of a catch-all lever because any implementation of business quality improvements, management team improvements, operational improvements, geographic expansion, whatever you're doing to grow the business is going to have an impact on the multiple. And so the multiple captures a lot of qualitative elements around the quality of a business that really can't be encapsulated anywhere else on the P&L. And then the third thing that you've got to talk about is the cash flow. And so what I say here is cash accumulation / debt pay down. Really, those are two sides of the same coin. If you're generating cash, you're going to be paying down debt. If you're paying down debt, then that means that you must have generated cash. And so that's a really, really important thing to generating a lot of the returns. And other things you might look at are like leverage rates, interest rates, exit timing, tax strategies, exit timing, dividend recaps. And all of these are good things to build into your model and to sensitize. But fundamentally, they shouldn't be the main things that you pay attention to in the same way that EBITDA growth, multiple expansion, and cash accumulation and debt paydown are. That's my opinion. Next up, between those different things that I just mentioned, EBITDA growth, multiple expansion, and cash accumulation and debt paydown, which can you most rely on to drive returns in a leveraged buyout analysis? Can you rely on the EBITDA to grow, the revenue to grow, the profitability to grow? Can you rely on the market to reward your business with greater multiples or avoid contraction? Can you rely on continuous generation of profits and paying down the debt over the course of the life cycle of the business? What is it? And so the best response here, in my opinion, is cash flow. Ultimately, at the end of the day, you've got to think about how fickle everything else is. Multiple expansion, you can't really rely on. It's like it either happens or it doesn't. And to some extent, that's just driven by the market. EBITDA expansion, second, is also hard. Like it's very, very tricky to either grow the revenue of the business or to grow the profitability of the business. And so you can't really tell ahead of time if you're going to be able to do that as effectively as you'd like. But on the other side of things, it's very easy to just keep collecting cash and keep paying down the debt. And so this is something to think about if you are operating a business or running a business is, can you just keep earning cash? And if that's stable, then in general, you're going to have good cash flows and you're going to have a higher value on your LBO. So with that, let's move to question number 7. So right now we're talking a little bit about debt, a little bit about LBOs, a little bit about private equity. Now, how would you go about actually modeling out a revolver? Now, for those of you who don't know what a revolver is, I'm not talking about a handgun. I'm talking about a corporate credit card, basically. And so a revolver is a credit mechanism issued by a large bank to a company to help them account for day-to-day expenses. And so, for example, let's say that I'm a construction company and I'm trying to build a house and I've got to go purchase some lumber from the store. and I need to have some degree of credit to buy hundreds of thousands of dollars of this equipment and all of this to actually build the house. And so I'll go to a bank like Bank of America or something like that. They'll issue to me a revolver, and then I'll use that to buy the lumber, build the house, and pay it off pretty quickly. Now, revolvers are pretty simple in the fact that they are very senior in the debt structure. So they get paid back first, and they've got relatively low interest rates. And so that means that they're more senior, they're less risky, and they're usually going to be more affordable for companies to use than a high yield or mezzanine debt or something like that. But think about it when you actually model it. If anyone knows the actual modeling mechanics of how you build a revolver. Now, a revolver starts with levered free cash flow. And so you want to start with the levered free cash flow from the P&L and basically try to understand what cash is actually available to either draw or pay down on the revolver. And so if you have negative cash flow because you went and you bought all that lumber for the house, for example, you're going to need to draw on the revolver. If you've got very positive cash flow, you're going to use that to pay off all the stuff that you bought last period. And so the repayment is going to basically be the levered free cash flows of the cash you generate minus whatever debt obligations you have, that mandatory amortization, and then plus the difference between the beginning and the ending cash and the minimum cash. And so let's say that you start with $100 of debt, and then you end up needing at least $50 or $100 of cash, and you need at least 50, then that means you've got sort of $50 of cash that you can play around with. And so then if you have $100 of levered free cash flow and zero mandatory amortization, that means you've got $100 of levered free cash flow plus $50 of extra cash. That means that you could theoretically pay down $150 of your revolver. Conversely, if your levered free cash flow is negative, then that's going to mean that you're going to be drawing on the revolver as opposed to paying it down. So make sure you've got this formula here. Either write it down, take a screenshot, take a picture with your phone, because you're about to need it in just 1 second. And this is a great question also to memorize in case you're curious about having this formula in your head. So let's take a look at another question that applies the same principles we just described. So let's say that you've got a business where you've got levered free cash flow of $100, and you've got mandatory amortization on your debt of $10, but you also have a little bit of extra cash. You've got $65 at the beginning of the period, but realistically, you only need minimum of $50. What is your repayment or draw on the revolver going to be based off of these numbers? And so for those of you who, again, don't know the revolver draw or repayment formula, this is going to be that the repayment equals levered free cash flow minus the mandatory amortization of all the debt that you have to pay off, plus the difference in excess cash, basically. And so the amount of cash that you have based on what you had at the beginning relative to what you actually need. So take a second and think through what this could look like. Now, one other key piece to note here is that when we're thinking about whether to use levered or unlevered free cash flow, realistically, we're thinking about levered free cash flow because we're looking at the amount that's available after you've already paid down the mandatory like interest payments or mandatory amortization. And so that stuff is going to be senior to whatever discretionary debt pay down that we have, because levered free cash flow is the stuff that's available to the equity holders. And so the equity holders can either decide, hey, we're going to pay down the revolver, or we're going to keep this as equity. And so that's why we start with the levered free cash flow. But the answer, as many people are getting here, is 105. And so that's theoretically the response here, but you've also got to question yourself when you're answering a tricky technical question like this, like what if the revolver balance is zero? And so if the revolver balance is zero, it's not like you're going to have a negative balance here. And so really what we do in financial models when we build them is we take the minimum of the beginning balance and the repayment formula. So we take the minimum of, hey, what did we have at the beginning and whatever cash we theoretically could pay down. And so that's a very important thing to build into your financial models to make sure that you don't accidentally end up with a negative debt balance, which doesn't really make sense. You're not lending money to the bank. Okay, so we've talked a lot about LBOs. We've talked a lot about debt. We've talked a lot about private equity. Let's shift gears a little bit more towards accretion dilution. Now, accretion dilution is one of the single scariest topics to many students that I work with because it requires a lot of steps. It requires a lot of memorization of formulas, and there's a lot of complexity to it. So let's talk through this in a little bit of a simpler manner just to start. Let's say that we've got an accretion dilution that's associated with issuing new debt to repurchase shares. So let's start out and say we've got $100 of debt that's at 10%, and we've got a 40% tax rate on it. We've got 110 shares in the business at $10 per share, and we've got $56 of net income. Now, this is going to sound like some weird numbers here, but they're designed this way for a purpose. And so I want you to take a second and work through whether this is accretive, dilutive, or if you don't have enough information to actually solve the question. Now, if you're not sure how to approach this, no worries. Let's talk through it together. While you're working through the problem, let's discuss some of the first principles. So the first thing that I always like to do in my accretion dilution questions is to understand what the beginning earnings per share is. And so a good place might be to start just standing and understanding like, okay, what is the earnings per share relative to, or the earnings relative to the share count? And so that way you can calculate what the EPS is. If you don't know what the EPS is at the beginning, then how are you supposed to compare what it's actually going to be at the end? But then the second thing you've got to understand is, okay, what is the net income going to be in the future? And so you've got to take the net income in the prior period. If there's a new company that you're acquiring or divesting, you've got to adjust the net income. And then you've got to make adjustments for the transaction consideration. So in this case, that would be for the debt. Now, quick note on the debt, you've got to take into account not just the interest cash, but the post-tax interest. And so many people, they come to this sort of problem and they make a mistake because they say, hey, it's going to be 10% interest on this debt or something like that. And then they're just like, oh, good to go. That's all I need to know. But realistically, remember that debt has a tax shield. And so the government, for whatever reason, has decided to subsidize interest payments on debt, such that in reality, you're not actually paying 10%. On a post-tax basis, you're only paying, in this case, 6%. And so with that, you're able to calculate the post-tax cost of debt that's going to impact the net income. And then the only other thing that you have to do is just adjust the denominator. And so before, if the share count is 110, the share count is going to now be less than 110. And that's where you have to understand, okay, how many shares can we actually repurchase with the debt there? Okay, this is an exciting one. And the answer, in fact, is dilutive. This is a question that is quite tricky to do from a mental math perspective. So talking through this a little bit more, the first thing that you do, like I said, is calculate the standalone EPS. So you take the net income, divide by the number of shares, and that gets you to the earnings per share. Then you've got to figure out what is the new net income going to be. And so you've got the dollars multiplied by, subtract out the tax rate, and then that gets you to ultimately the new net income, which, as we said, is $50. But you purchase back some shares, so the denominator is also a little bit lower at 100. And so the EPS just goes down ever so slightly from 51 cents to 50 cents. You see why I made the numbers as specific as I did. Now, this sort of question trips up a lot of candidates for investment banking recruiting. And so if that's you, no worries. Let's set up some time to talk. Because realistically, most candidates only ever study the 400 question guide. They only ever look at the most basic questions you can find online. But the reality is that the investment bankers know those guides. Like I knew those guides when I was writing the questions for Catalyst and Lazard, and therefore I didn't ask those questions. I asked harder stuff to understand the students that really understood the concepts versus the ones that just didn't understand it all. And so if you haven't met with Wall Street Mastermind yet, please go ahead, book a call with someone on our team, and we can talk about how we can help with technical preparation. But with that, let's keep going. There's a bunch more questions that we've got to cover before we wrap up tonight. Number 10, let's say the company has $100 of PP&E that depreciates on a straight line basis over 10 years. And for book purposes, it's 10 years, but for tax purposes, it depreciates at 20 in the first year. And so if you're assuming a 40% tax rate after year one, what is going to be the impact of the accelerated depreciation on the income statement and balance sheet? So this is a tricky one. Now, while you're thinking through it, let me just share a little bit of commentary. So the first thing you need to think about here is understanding what's going on with the tax accounting versus the GAAP accounting. What do I need to know? And so the first part that you've got to consider is, okay, what is the actual depreciation going to be? And so that's going to go then flow through the financial statements in the same way that we talk about in the classic, like how does $10 of depreciation flow through the income statement? And so the depreciation is going to have, on a post-tax basis, it's going to have an impact on net income. And then on the cash flow from operations statement, you're usually going to have to add back the depreciation. So it usually ends up being a positive impact to cash on the cash flow from operations. And then usually the way that this works conceptually is that then flows into the balance sheet where the cash goes up, the PP&E goes down because you depreciate it, and then the retained earnings goes down to sort of balance things out. And so the tricky part about this question is understanding the tax accounting versus the GAAP accounting. And one key realization that I'll give just to have a little bit of a hint here is you've got to understand, how does this sort of difference between the tax accounting and the GAAP accounting impact things? Well, realistically, the tax accounting isn't going to impact the income statement. So the first thing that I'll just share again is that the tax accounting doesn't actually impact the income statement here. And so the income statement isn't going to have a real outcome. Now, what is going to happen is that there's going to be a difference in terms of the cash and the DTL. And so on the cash side, we're going to have $4 higher ultimately. And there's going to be a liability of an approximately equal amount. And where do we get the $4? Well, that's the $10 of difference between the GAAP and the tax accounting multiplied by the tax rate. So what's the principle here? Well, the principle is that in order to find the impact of a DTL, you basically take the difference between the GAAP and the tax books and multiply it by 40%. Now, don't worry if this is something that's confusing. Like, this is a topic that many people have a very hard time with. Deferred tax assets and liabilities are among the most intellectually complex elements of high finance. Let's move forward a little bit. Let's say that you've got two companies that trade at 2 times revenue. One trades at 6x EBITDA, and the other trades at 8x EBITDA. What are the companies' respective margins? So as you think through this question, start to just evaluate the data that you have. And so a lot of the times when interviewers, they give you a question, you've got to think through, okay, is this actually enough information, or do I need to ask for anything else? Or is there a creative way to back solve into these things? And so one other trick that you could try here is attaching actual numbers to it. So like, just make something up. Let's say that you had instead of putting multiples to it, you say, okay, what if our company had $200 of revenue or something? Then that would mean it's trading at 400, 2 times 200, so 400. And so it's $400 of enterprise value. And then you can sort of back into what the EBITDA would be for each of those things, if it's 6x and 8x, and then you can calculate what the margins would be. And so take a second and think through and see if you can do the algebra necessary to calculate what the margins would be given the multiples of the business, revenue and EBITDA. Okay. We're going to move forward pretty quickly here because we've got another few questions. And I also want to get into some of the frameworks that really drive things going forward. So the answer here, in fact, is 33% and 25% respectively. In fact, you can just take the revenue multiple divided by the EBITDA multiple. That gets you halfway there. And so then you can also try just plugging in the different numbers if you have it and solve. And so if we've got a 2x revenue multiple and a 6x EBITDA multiple, that's going to be a 33% margin right there. And you could figure that out if you just plugged in some numbers to try and solve it. So moving right along here, let's say that we've got companies that have one value with, let's say that we have two companies and we're looking at the value of a company with NOLs. How would you estimate the value of those NOLs? So just one more time here, let's say that you're looking at a company, you're trying to understand what is it going to be worth, and it's got net operating losses, NOLs. How would you estimate the value of those NOLs? And try and arrive at a conceptual answer that you can post in the chat about how you'd think about the valuation of a net operating loss. Now, for those of you who aren't familiar with net operating losses, let me talk a little bit about that while you're thinking through this. So net operating loss is basically the government saying, hey, you lost money last year or in the year before that or something like that, and you weren't able to effectively deduct that on your taxes because you had negative income. And so we're not going to like pay you positive taxes, but that should have been deductible because it was legitimate expenses that are tax deductible. And so they say, okay, we'll let you carry that forward into future periods. And there are restrictions on how much you can carry forward and when and things like that. But realistically, that net operating loss, even though it sounds like a bad thing, is actually a good thing going forward from a tax perspective. Because what it means is that in the future, you're going to have lower taxes. And so realistically, how you calculate this is like a DCF. So whenever you think about NOLs, I want you to think about it like a DCF, where you calculate out what the NOLs are going to be in each year, take the pre-tax NOL value, and then multiply it by the tax rate. And so if you had $100 of losses last year and a 40% tax rate, that would be a $40 NOL that you get next year. And you net that against the forecasted earnings, figure out what the cash flow is going to be, and discount that back using the weighted average cost of capital, the WACC. Moving right along, we've got a few more questions, and I really am excited to get you through to some of these frameworks and study techniques if this is challenging. So 13, let's say that you're running a company that can earn the same incremental revenue by either raising price or raising volume. Which option would you engage in? This is a classic question about whether you would prefer an increase in price or an increase in volume, or if you think it depends. There's some interesting thinking that happens in this because you've got to weigh a couple considerations. Like, do you realistically want to have higher price and potentially higher margins? Or do you want to increase the volume and just have like a huge machine running where you have more customers and more success and higher volume of delivery? Or is there some third factor that you've got to think about? Now, for me, this is a judgment call, but I would say, in fact, it does depend. Because on one hand, the price is pure cash flow. And so if you get an increase of price by 10%, then you're going to get more cash. That's just the way that the math works. But you're also probably going to alienate some of your customers, and you're going to have lower value proposition, like lower consumer surplus in the future that could impede the growth of your company. If you increase the volume, on the other hand, you're going to have the same margins, but there's greater future earnings potential. And so in general, I probably do actually lean towards volume, because you can usually raise prices eventually, but you can't raise volume quite as easily. So question 14, let's say that a public company has fixed rate high yield bonds. How would you compare the returns profile of investing in the company's bonds versus the company's stock? So this one's a little bit more conceptual. So I'm going to start walking you through this while you continue to think. On the first side, you've just got to recognize that there's several steps to each piece of it. And the first part is figuring out the yield of the bonds. And so on the yield of the bonds, you've got to think through, okay, what is actually going to come to me as the investor? And so first, you've got this coupon payment where you're going to get regular sort of dividends from a debt perspective, where they're going to pay you the coupon, but then you're also going to get an appreciation in the face value of the bond. And so this comes with a little bit of jargon. When I say par, I mean, what is the value of the bond at repayment? Purchase price is, of course, whatever I pay for it. And then the tenor is the lifespan of the bond. And so if I bought this for $100 and it's going to eventually sell for $1,000, that means I'm going to gain 900 by the time it exits and the bond's done. The second then is you've got to take that and you compare it against the free cash flow yield of the public stock. And so this is going to be an IRR of a stock investment, including both the dividends and also the share price appreciation. So there's two factors in calculating the public value of the equity. And then after that, it's just assessing the qualitative risk of the stock. And so is there going to be subordination? Is there interest rate risk? Is there asset coverage? What is the risk of the stock? Okay. I'll finish with one question, and then we're going to get into our frameworks and how to study from here. Because if this has been at all confusing, if you missed a single one of these questions, you may not quite be ready for the technical interviews that you've got coming up. And so I want to make sure that you know how to study from here. So the last question I'm going to give you is an LBO-ish one, where you're thinking through returns. And it's very, very good to be thinking through the investor mindset, even if you are an investment banker, because oftentimes you're working with financial sponsors or companies that think like financial sponsors when they're doing M&A. So let's say you've got a company that you're purchasing at 7 times EBITDA. The EBITDA doubles and you have no leverage. What are your returns going to be on equity? Now, the second variant of this question, though, is what if your returns double or your EBITDA doubles and you've got 4x leverage? So take a second and think through, how are your returns going to change with the impact of leverage? Now, the reason I like this question while you're thinking through it is just because fundamentally, you've got to understand how much equity is juiced in terms of returns by leverage. And so in the same way that you wouldn't want to buy an entire house without a mortgage, unless you've just got a lot of extra cash sitting around, you wouldn't want to buy a company without debt, unless, again, you've got way too much cash sitting around, which rarely people do. So take a second, calculate out what would your returns be in both scenarios. I'll walk you through the equity one while you're still working on the debt one. So on the equity side of things, it's actually pretty simple. Let's say that you bought the company and the equity doubled, or the EBITDA doubled, and you didn't have any debt. Well, then realistically, the doubling of EBITDA is going to flow right back to you as the equity investor. And so that one's super simple. It's a trick question. It's going to be a 2x MOIC if you just have equity. So just remember that principle. If profitability doubles or revenue doubles or something like that, and you don't have any debt, your profitability is going to double. Now, realistically, private equity firms expect their returns to more than double, and often the revenue and the EBITDA don't double. And so how do we get there? Well, leverage. So let's talk through what that math looks like. On the leverage side of things, the easiest way to think through this, again, is just to put numbers to it. And this is a general tip in interviews for technicals, is just to put numbers to things. And so, for example, let's say that you had a $700 million entry price. So you had $100 million of EBITDA times 7 equals a $700 million EBITDA, or $700 million enterprise value. And then that's split up between equity and debt, 300 and 400 respectively. And so that means that when you exit at the same multiple, you're going to have $1.4 billion in enterprise value. And then assuming there's no debt pay down, the debt's going to stay same as like a dollar amount, and the equity is going to capture all of that upside. And so that means that you're going to get $1 billion of equity, the 1.4 billion minus a billion, or minus 400 million, divided by a $300 million entry. And so that's a 3.33x. Now, realistically, it could easily go the other way around, where if the EBITDA halved, you would very, very quickly end up with no equity value or even negative equity value, and the debt would remain outstanding. We talked about LBO drivers and revolvers. We did some work on accretion, dilution, CapEx, PP&E, talked about margins, net operating losses, public equities, debt, SaaS, investor judgment, you name it, we've been through it tonight. And so this is a very wide arrangement of topics And odds are you didn't get all of them right. And the reason that the best candidates do get it right, though, is because they know how to study. And there's two halves to the studying. The first is theory, and the second is practice. So let's break each of those down a little bit more and help you understand how to study these effectively. So on the theory side of things, there's three ways that you can get the concepts down to understand this the best. The first is courses from Wall Street Mastermind. We've got dozens of hours of online tech content that is going to help you get your technicals up to speed and help you understand the theoretical understanding of these technicals as quickly as possible. And this is going to be so much more effective than going and trying to find a bazillion YouTube videos, because we really slim it down to the key concepts you need to know. And then we pair it with the real understanding of how this actually applies. Second thing is school courses. For those of you who are in university or not graduated yet, this is something where you've got to take as many classes on finance and accounting as possible. But the third thing that almost everyone forgets to do is just to track what you don't know. It's remarkable to me how many students come to me and they're like, hey, I don't think I'm that good at technicals. And I'm like, well, which technicals? There's so many of them. And they say, I don't know. And I say, well, why don't you know? Because you didn't write it down. And so tonight you should be emerging with a list of topics that you need to go research. And that's something that we can help you research at Wall Street Mastermind, but that's not something that you can just let go and just say, hey, I'm going to hope that I don't get that technical. But once you have the theory down, there's a practical side to it as well. And so I'm going to share a few more tips on the practical study resources, and then I'm going to share my last final secret about how to ace technicals. So on the practical side of things, there's three places I would start. The first is the technical cheat sheet. Now, for those of you who haven't seen the technical cheat sheet, I'm going to paste that in the chat right now. I'm going to make sure that you all have access to that, because this is going to be probably the single most helpful resource that you've got in terms of just getting the basics down as quickly as possible. And so grab that right there. That's going to have all the formulas. It's going to have all the information that you need to really just jam through your technicals as quickly as possible. So please go grab that. Make sure that you don't get caught flat-footed by any of the topics that we talked about today. The second thing is AI tools. And so at Wall Street Mastermind, we provide all of our students access to Ask Stanley and Thea. There's other tools like ibvine.io out there that will really help you regurgitate, and even Quizlet, for example, will help you think through and use flashcards and really understand what technical finance topics you understand and don't after you've done and tried to understand the concepts directly. But the last piece that is probably the most important place is mock interviews. And so almost everyone that I work with doesn't do enough mock interviews. And so either with a peer or with a coach. And at Wall Street Mastermind, we do provide unlimited coaching on technical mocks. And we have office hours where you get to see people get technically mocked live, similar to what we've done tonight. And so that sort of thing is going to be extraordinarily helpful in terms of actually making sure that you're good with getting nervous and practicing these sort of concepts. And so the last thing that I'll just share in terms of time before I share the final secret to how to ace your technical interviews is just making sure that you're spending enough time on this. And outside of peak recruiting season, that means at least an hour a day on the weekdays and probably 3 hours plus on the weekends. Now, given that we're in peak recruiting season, many of you are probably already jamming at least that much. And you've got interviews and super days coming up, in which case I would say at least double this is probably appropriate, especially if you ever have a school break and you don't have a full-time obligation. So with that, I'm going to share my last secret in terms of how to ace your technical interviews. And the real thing there is to make sure that people actually really freaking like you. And there's a couple ways to do this. And I'll talk a little bit more about what I mean. But the first way is to network, and the second way is to have really rock solid behaviorals. And so I'm just going to tell you a little bit of a story. When I was doing analyst recruiting for Lazard, which is one of the best elite boutiques on the street, I was terrified of the technicals. Like, I'd been studying the 400 question guide. I'd been mocking with upperclassmen. Wall Street Mastermind didn't exist back then. And so I said, hey, what can I control about this? Well, I can control if my interviewer starts out liking me or if they start out skeptical. And I can also control what sort of behavioral questions I have to answer with. And so, for example, on the behavioral side of things, instead of just having like a boring tell me about yourself answer or something like that, I came up with a freaking incredible story that everyone wanted to pay attention to. And we spent so much time talking about those things that they didn't actually get around to the technicals until the very end of the interview. And so I remember some of the interviewers at Lazard, they were like, oh crap, like Max, we've only got like 2 or 3 minutes left. And I've got to ask you a technical, walk me through a DCF. And so I ended up with all these softball technicals because I was able to distract them with the fact that we'd already had a pre-existing relationship. So don't let the technicals entirely occupy your focus to the point where you don't know the technicals and the networking. So reflecting on this, I hope that you've learned a little bit of something to help avoid being part of the 0.6% tonight. Like, realistically, There's no reason that all of you can't get a little closer to that 90% with Wall Street Mastermind's help, I hope. And if not, through using some of the techniques that we've talked about tonight. So with that, I'm just going to leave you with a few closing thoughts, which is, first off, please appreciate how difficult it is to get into some of these investment banking positions and how important the technicals in particular are as a differentiator between candidates. It's the single easiest reason to kill a candidate's process if they miss up a single technical. So please feel free, book a call, and make sure that we are able to meet and help you out as much as possible. Have a great night.